How to use life insurance to build wealth. It is one of the most unique strategies, and when you use it in the form of infinite banking, where you actually could become a bank, use the cash value, and have a huge death benefit, and be a shareholder of the company, it's supreme. So the three things we're going to talk about, and we're going to interview my partner, Jason Henderson, about insurance and a deep dive into the following. How do you understand the cash value of life insurance, and how do you really use it? How do you borrow against your policy and keep it healthy so you're not depleting it? And number three, the common mistakes people use with insurance and trying to accomplish wealth building. And I can tell you the number one mistake is you buy death insurance, not life insurance. So with that, let's go to Jason and we'll talk through these strategies. So let's move over to this interview with Jason, where we're going to talk about the three things I just mentioned. So let's start, Jason, and welcome to our YouTube channel and our conversations. We're actually going to do a series of 4 and really help educate people about insurance properly. So just the first basic one is understanding the cash value of life insurance. How do people even understand that? Because I don't think people, as you know, they know death insurance, they don't know real life insurance.
Yeah, but sounds good. Good question. The thing that most people don't understand is the cash value is your equity in a contract. So a whole life insurance policy is basically a contract. The company is saying that at a given age, maybe 100 or 121, that they will guarantee that in exchange for regular increments of investments or contributions or savings, whatever you want to call those, that your money will grow to a certain amount. And in the event you were to pass, then there is a death benefit that goes with it. Yet when you make those individual and regular contributions, your cash value grows. Now, I know that's kind of technical. Let me give you an example. You purchase a house for $500,000. You may make a down payment or whatever do. Every month you make mortgage payments, and what you have is your equity in your home is growing each time you're making a mortgage payment. Now, let's forget about or take away the idea of the house appreciating. Simply what your principal or equity in the house, that's equivalent to the cash value in a whole life insurance policy.
Interesting. Just to kind of back up a little, because most people do have death insurance, which is term insurance. Just give a few statements of why that's just, to us, it's a waste of money. I mean, it's sort of obvious, but I want you to have a comment inside.
Well, I was thinking recently, what's the most expensive type of insurance? The most expensive type of insurance is the insurance that's not in force when you die. So when you look at it that way, what's the most likely for that to happen, for you to not to have insurance when you die, is term insurance. That's why that's the most expensive. The second most is ULs, whether that's EIULs, VULs, EIULs, IULs. That's the second most likely to not be in force when you die. That's the most expensive type of insurance. If you take it around backwards and you look at it from the insurance company's point of view, okay, what they're seeing from their profit and loss, they see term insurance as the most profitable product. They see universal life as the second most profitable, and whole life as the least profitable, for the fact that they never pay out on the death benefit. That's the biggest expense to the insurance companies, paying out on that death benefit. That's why you and I love to call those ULs and term insurance death insurance. In order for there to be a benefit, someone's got to die.
So talk about how to borrow against your policy to invest, because I've pulled from mine, put my money back, but I mean, you use it like a bank. So talk about how you can use that.
It's very, very similar. Let's go back to the house and the equity in a home.
Yep.
Most everybody knows that you can go to the bank and you can beg them to give you a line of credit on the equity in your home, which is called a HELOC. In a similar fashion, the cash value of your policy can act as the collateral for a loan from the insurance company or from anybody else that's willing to loan you against that collateral, right? So in that way, you're then able to use the equity inside of your life insurance policy as equity and collateral and take a loan against that. Now, will the insurance value, the cash value, continue to appreciate at its full amount? Absolutely. Similar to with the home, when you take a HELOC, the house can still appreciate, right? Even though you take a loan against your HELOC. In a similar fashion, you can do that with life insurance. And that's the best way to use life insurance as a way to get equity or a way to get money or capital to go after whatever it is, whether that's an investment, take care of an expense, a major expense, go on a business trip, whatever you have.
So are there limitations? Because I have two questions around the investing is what does it cost to borrow? A lot of people say, and you've heard this the same thing I've heard, what does it cost to borrow my own money back? So why am I paying interest on my own money? So I want you to address that. And then are there limitations on what they can invest in?
Like with the home and you have a HELOC, are you borrowing your money? No, you're borrowing money from the bank using your equity in your home as collateral. That's why you're required to pay back the bank principal and interest. The same thing can happen with your cash value of your life insurance. It is simply collateral. In the event we were to say, this is my insurance policy and this is my collateral, I can get a loan from the insurance company using my cash value as collateral for a loan from the insurance company. I could also take this same insurance policy and walk into most any bank in the country and say, here, I have an insurance policy. Here's the cash value. Give me a loan against my cash value, and the bank would loan you their money. You would be required to pay them principal and interest while your money is still at the insurance company. And there's several other companies out there that'll do the same thing. So it's really not borrowing your own money. You're using your money as collateral. That's a very fine point that when you wrap your head around it, you start to realize that this truly is a financing tool, and this is a wealth building tool for the fact that you are using other people's money, OPM, that everybody knows about. What was the second question that you had?
Limitations on investing. Like I want to ask that because a lot of times people say, I want to put a gas and oil project in an IRA. I'm like, you lose the depreciation. So that's a horrible vehicle. I mean, do what you want to do, but that's an obvious, really bad move. So are there some restrictions around the investing choices that once you do get the money?
So no, there isn't any restrictions around borrowing the money. This is governed by a private contract, which I really like. When you're talking about some other vehicles such as a 401k or IRA, that's not a truly private contract. You have a partner there in the government that has the ability to change the rules or to dictate to you what you can and cannot do. With a whole life insurance policy, you are in control. It's a unilateral contract that you own and control. So when you get a loan, you don't even need to qualify for that loan. Right? There's no qualification whatsoever. It's simply your signature for the fact that you have collateral already at the company and you have say over what the company does with those funds, and you can invest it in anything and in any way you want.
So those of you that are interested, that want to learn more, go to INSURETYSystems.com. We have a free report. I'll have Jason talk about that more in a moment and a few more free gifts. Before we do that though, while you're here on my YouTube channel, I need you to subscribe if you haven't. Click that notification button. Be here 5 days a week. And videos like this, share with your spouses, your family, and I'm going to say your parents. So a lot of you're going to inherit money. It's not held in a trust. It's not insured properly. You're going to get taxed to pieces at the estate upon death. So please schedule some time with our team. So to that point, there will be a link in the INSURETYSystems.com, which will go to Jason, talk a little bit about the appointment they're going to have, and then we're going to wrap up with some more gifts and big mistakes we see people make.
Yeah, so when you go to INSURETYSystems.com, there's a report there that kind of breaks down some of the uneasiness that people have when it comes to life insurance and addresses some of the objections that people have about life insurance. It's particularly one that they may have heard on the radio and some pundits out there saying, oh, this is a terrible place to put money. It really puts you at ease. It helps you understand why this really is the best investment vehicle you can find and why this makes every other investment you have better. There's also the free gift of a chapter from Loral's book and a chapter of another book that's a bonus. So yeah, there's more than simply signing up. There's some free gifts there that's really good.
And then once you really go through it, then sign up for an appointment and we'll talk through it. Jason and the team will talk through it more. So before we close out though, Jason, just a few comments on the biggest mistakes that you see, people make when they want to use this kind of insurance for wealth building. What do they do wrong?
One of them is they quit too soon. You know that in the event you bought a house and you make 5 years worth of mortgage payments, then you decided not to make make any more mortgage payments, you're going to lose all your equity. That's not necessarily the case here. However, you could lose money in the event if you don't get into the contract long enough. When you're into it, say 6, 7, 8 years, your cash value is going to be equal or greater than your total premiums that you've contributed. So in the event you start it and then stop it, say in 1 or 2, 3 years, there's a possibility to lose money there. That would be silly. It would be unwise. That's probably the biggest common mistake. Another common mistake is that when you take a loan, you're not paying it back. For the fact you think it's my money, it's simply going to my account. It's not. Think of it like the HELOC. You don't make payments on your HELOC, the bank's coming after you. You don't make payments on your insurance policy, no one's necessarily coming after you. However, you are destroying the incredible financing tool that you have set up, which then possibly could cost you money in the form of taxes, or you could lose money. And the other one, I would say the big mistake is not finding the right kind of person. In fact, that's the biggest mistake. You don't find the right person that designs a policy for you versus design a policy for commission for the agent. There's a huge difference there. That's why you need to go to INSURETYSYSTEMS.com. Loral has vetted me to be the right kind of person. And in an event I were to write a policy that's not the correct one, trust me, she's coming after me.
So we got to wrap this one up. Jason, it's great to have you here. And again, if you want to learn more about insurance, Jason, I have a variety of videos, going to continue to make them for you. But go to INSURETYSYSTEMS.com, grab the report, all the free gifts, and sign up for some time. Just learn more. It's a great recession-proof investment. Even though I'm not giving advice, I'm just giving my opinion. It's good. At any point, though, if you have any questions on my YouTube channel, make some comments below and go to askloral.com, ASKLORAL, ask a question, make a request. We're there 24/7 to answer and be available for you. We'll talk tomorrow.